Did you know that there's a secret cost to borrowing from your 401k? Well, there is, and that's not all. Borrowing from your 401k will put a drag on your portfolio returns, plus you run the risk of paying extra taxes and penalties if the loan is not paid back within a certain amount of time. In this video, we'll discuss why borrowing from your 401k is not advisable and why it makes sense to consider the alternatives. First, let's look at the invisible extra cost of taking out a 401k loan. We'll use the example of Dr. Emily to illustrate these hidden costs. Dr. Emily earns $300,000 as an internist at a major medical institution. She contributes 5% of her earnings to a 401k, so her taxable income would be about $285,000. Let's assume that she's single and has no dependents. Ignoring the deductions, she would have an average tax rate of about 24% and pay about $72,000 in taxes. Subsequently, she borrows $50,000 from her 401k, which she intends to pay back over 5 years. The interest rate is 5%, and so the annual payment would be about $11,322. Now, Dr. Emily believes she'll come out even in this deal. She took out $50,000 and she'll be paying back $50,000. The interest she pays on the loan will go to her account. She'll be paying with one hand and receiving the same amount with the other. Unfortunately, there's more to this than meets the eye. There's a hidden cost to borrowing from your 401k. That is so even though there are no penalties when you borrow, quite unlike the situation if you make a withdrawal from your 401k. Note, withdrawals from a 401k are permanent drawdowns. Loans are temporary and must be repaid within 5 years. That hidden cost arises because you'll be borrowing pre-tax dollars but repaying with post-tax dollars. Converting those post-tax dollar repayments to pre-tax dollars generates the hidden costs we talked about. On top of that, you'll have to pay tax again on those post-tax dollars when you take the money out of your 401k in later years. Let's run the numbers to see how that works. Now, the crucial thing to remember is that with a traditional 401k, contributions are made before income is taxed. Consequently, all the money in a plan consists of pre-tax dollars. However, repayments to a 401k loan will naturally be made from income that is already taxed, that is, from after-tax dollars. The effect of this then is that repaying $11,322 in after-tax dollars requires a higher pre-tax income. We calculate the pre-tax income needed using Dr. Emily's marginal rate, which, based on her income, is 35%. The pre-tax income required would be the $11,322 divided by 1 minus 0.35. So that would be about $17,420. As a result, Dr. Emily will end up paying more of her after-tax income than she expected, and her take-home pay will go down by $6,096.86. Note that the calculation uses the marginal tax rate, not the average tax rate, because the marginal tax rate is the rate applied to the last dollar of income earned, which makes it relevant rate when determining the additional income needed to cover the specific expense. Of course, you won't take out a loan without intending to repay. However, life happens and a variety of circumstances may arise that make repaying the 401k loan difficult or impossible within the permissible time frame. Remember, you have just 5 years to repay a 401k loan. Sadly, when rainy days appear and you experience a cash crunch, there's the risk you may default on the loan. It may be difficult to make the loan payment, although generally such payments are made by salary deduction. It is a situation you'll want to avoid because defaulting on the loan, that is, paying neither the principal nor the interest according to the loan agreement, could turn the outstanding loan balance into a planned distribution. The unpaid portion of the loan is now treated as a permanent withdrawal from your 401k. This can cost you dearly. Distributions are subject to income tax, so you have to include the amount in your gross income to be taxed in the year of default. In addition, you may have to pay an additional 10% tax on the amount of your distribution if you haven't reached age 59 and a half. Your default risk can increase unexpectedly even when you're paying on time. That's because your plan may require you to repay the loan in full if you leave your present job. However, that's not always the case. Some plans may have specific provisions that allow for continued loan repayment through a separation agreement. Or perhaps the unpaid loan balance can be rolled over into another qualified retirement plan. Borrowing from your 401k has other implications. Your retirement savings will be hit by a double whammy. Let's take a case of Dr. Bob to see how this works. Bob, a cardiologist, has borrowed $100,000 from his 401k to buy a boat. The interest on his 401k loan is generally 1 to 2% higher than the prime rate. So let's assume the loan is at an interest rate of 10.5%. His plan prohibits contributions during the 5-year loan term. These would have mounted to 5% of his $300,000 annual salary. Thus, over the 5-year period he's repaying the loan, Dr. Bob wouldn't be able to make $75,000 in contributions. Now let's assume Bob's expected return on the funds invested in the stock market is about 10% a year. So $75,000 would be most likely have appreciated to approximately $120,788 after 5 years. This means that Dr. Bob would have had investment income of $45,788. That is, the $120,000 minus the $75,000 comes out to the approximate $45,000. The loss of income is an implicit cost that raises the APR of cost of borrowing. It also implicitly reduces the amount he borrowed, which becomes $100,000 minus $45,788, which equals $54,211. He gains $100,000 but loses out on about half that amount by doing so. If Dr. Bob's monthly installment consisted only of principal and interest at 10.5%, he could have ended up paying an approximate total $128,963 over the 5-year loan term. But now he's paying that much just for borrowing $54,212. So Dr. Bob is paying an APR of 41.34%. This is a contract that would make a loan shark smile. So if you plan investments primarily in stocks, and many plans do, even a relatively small outstanding balance of $5,000 can cost you $33,637 20 years down the road. That's because you'll be missing out on those returns if the money to earn them isn't there. So the interest rate is not the only cost of borrowing, there's also the opportunity cost of the investment income that you would be losing. Taken together, the interest rate and the rate of income that you might have been earning gives you the familiar annual percentage rate, or APR. The question is, do you want to be like Bob and borrow at an APR of 40%? Borrowing from a 401k seems like the easiest thing to do. After all, the money, or most of it, is yours, which means that you're standing on your own 2 feet. Isn't that better than borrowing from an external party? Well, for all the reasons we've just given, it's not such a great idea. You can end up paying more in taxes and fees, and your portfolio won't grow as fast as it should. Consider instead another way of raising the funds you need. You may be able to take a personal loan from a credit union or a bank, or a home equity line of credit if you own a home. The interest rates on these options are likely to be higher than the rate on your 401k loan, but remember, that's a false comparison. When you factor in the loss of investment income, loans from a reputable institution lenders will generally be better than a 401k loan. If you found this video helpful, don't forget to hit the like button and subscribe to the channel to stay up to date on all of our new videos. Have any questions or thoughts on borrowing from a 401k? Drop them in the comments below.